Good morning, viewers. It's Tuesday morning, May 20, 2025, and I'm your Sunil Thakker of Sunny Talks Money. Welcome to ST Money 7 a.m. early morning news, where we provide you the latest, concise, and precise stock market wrap with accurate figures and numbers. Please do mention your email in the comment section so that we can forward you the daily market wrap in your inbox at exactly 7 a.m. Eastern Time each weekday. US stocks finished near the unchanged mark on Monday, with market sentiment weakened by the downgrade of US government by Moody's. Equities had rebounded from declines earlier in the session to finish near the unchanged mark. The Dow Jones Industrial Average added up 0.32%. The S&P 500 managed to close above the flat line to extend its 5-day win streak to a sixth straight day. The tech-heavy Nasdaq Composite also rose slightly by 4 points. Moody's slashed the US sovereign credit rating to AA1 from AAA after markets closed on Friday, citing the government's $36 trillion outstanding debt and interest, denting the federal government's perfect sovereign credit rating owing to its huge debt profile. Adding to investor nerves about America's debt trajectory, the House Budget Committee approved President Trump's tax and spending bill late on Sunday, a milestone for a proposal that it is projected to add trillions of dollars to the deficit. The bill has several more obstacles to clear in the House and Senate. Meanwhile, investors digested development in President Trump's tariff salvos. Trump himself provided a broadside to US retail giant Walmart on social media, urging the company to eat the tariffs. Walmart had indicated it would raise prices in response to tariffs. It represented the latest pushback from the president against companies showing consumers the cost of his economic moves after a brief tit for tat last month with Amazon. On other tariffs front, Treasury Secretary Scott Bessent warned countries that their imports will return to facing Liberation Day hikes if they don't negotiate deals in good faith during the 90-day pause. He added that the US is focused on striking deals with 18 important trading partners. 7 out of the 11 S&P sectors advanced, led by healthcare, consumer staples, industrials, materials, and utility stocks. Energy stocks were the biggest losers in addition to consumer discretionary. Novavax shares jumped 15% after the company secured a long-awaited US regulatory approval for its COVID-19 vaccine. Regeneron Pharmaceuticals rose 0.4% after it announced it will buy genomics firm 23andMe holdings for $256 million through a bankruptcy auction. TXNM Energy rose 7% after the utility said it would be acquired by the infrastructure unit of Blackstone in a $11.5 billion deal. This week's calendar is light on scheduled economic announcements, and the market is monitoring manufacturing data and initial jobless claims. On the earnings front, with many of the heavy hitters already reporting for the quarter, attention will shift to key names in retail. Target and Home Depot are slated to report later in the week. Meanwhile, the dollar weakened and the treasury yields and gold prices rose. Benchmark 10-year treasury yields gained on concerns that a US tax bill will increase the debt load by more than previously expected. The yield on the benchmark 10-year notes rose to 4.473%. Gold prices rose about 1.5%, resuming a rally that sent them to record highs in early May. My take: should you buy US stocks after a Moody's downgrade? A Moody's downgrade of US sovereign debt, typically reflecting concerns around fiscal stability, debt levels, or political dysfunction, can understandably raise investor anxiety. However, history suggests that such downgrades, while headline grabbing, do not necessarily imply long term doom for equities. Instead, they often create short term volatility and potential buying opportunities for long term investors. Why would you do this? There are five considerations. One, market reaction tends to be short-lived. Following the 2011 S&P downgrade of US debt, equity markets initially fell sharply. However, the S&P 500 rebounded within months and continued its long-term upward trend. Investors may panic initially, but the US remains one of the world's most resilient and dynamic economies. Two, fundamentals still matter. Stock performance is ultimately tied to corporate earnings, consumer demand, and innovation. Most US companies operate globally with strong cash flows and balance sheets. For instance, a Moody's downgrade doesn't change Apple's cash flow, Nvidia's AI roadmap, or Microsoft's enterprise dominance. Three, safe haven status remains intact. Ironically, downgrades of US debt can lead to higher demand for US treasuries in times of global uncertainty. A paradox. This reflects continued faith in the US dollar and the overall economic system, which indirectly supports equity valuations. Number four, valuations and entry point. If stocks decline following the downgrade, investors may be able to accumulate high quality names at attractive valuations. Sectors such as technology, healthcare, and consumer staples often show resilience and long term growth potentials. And the fifth key element, risk management, is key. While a downgrade alone is not a reason to exit the market, it underscores the importance of diversification. A balanced portfolio across equities, bonds, and alternative assets remains prudent. So, in conclusion, buy selectively and stay focused on the long term. Rather than avoiding the market, investors should assess this moment as a potential buying opportunity, especially for fundamentally sound companies trading at a discount. Patience, discipline, and a long term perspective are critical when navigating headline driven volatility. That's the wrap for today, my dear viewers. And if you got value from this, please do subscribe, like, and share this video as much as possible. I'll see you again tomorrow morning. In the meantime, happy investing, stay inspired, and remember, it is all about money.